Hello students, this is the first video on the new Finance Act, that is FA19, and this is going to be applicable from June 2020, and then in September, then in December, and then March 2021. So what are the changes that has been made in FA19? We will discuss these changes as well. But first of all, it's a basic introductory lecture of SECA TX exam. So let's begin with the basics. First of all, we are studying about Finance Act 19, and it's a UK version of the tax. So it's applicable in UK. And as far as the tax year for individual in UK is concerned, it's 6th April to 5th April. So a tax year starts from 6th April 19 to 5th April 2020 will be a tax year of 1918. You can write in this way, 1920. So this is tax year 1920, also called FA19. So if an individual earned income in this tax year, he or she has to pay tax as per the tax rule in FA19. So as far as income tax computation is concerned, first of all, we have to identify the types of income on which we have to apply income tax rate. So for that purpose, three types of income can be identified. One is called the non-saving income, other is called the saving income, and third one is the dividend income. So all the source of income that an individual earn in a particular tax year will be classified as non-saving, saving income, and then dividend income. Now, as far as saving income is concerned, it is related to interest income. So any interest income from any source, unless it is an exempt income, it is considered as saving income. Dividend is normal, any kind of dividend that we have received in from the shares. So this is classified as dividend income. Now, as far as non-saving income is concerned, it is other than dividend income and saving income. And usually in our syllabus, the types of non-saving income that we have to came across is employment income from a salaried person, tax adjusted trading profit from a sole trader or a partnership business. This is a salaried person, and the property rental business. So anyone who is earning profit or income from these sources will be classified as non-saving income. Now, these tax rates will be given to you in the tax sheet that will be provided you in the exam. And as far as the rates are concerned, the income tax rates are concerned, these have been classified as the normal rates and dividend rates. So the normal rates is applicable on non-saving income as well as saving income. This is applicable to both type of income. So now you can see that there are different rates, and rates are increasing. So this is a type of a tax system which is called the progressive tax system, which is applicable in UK on income tax. And it is based on the threshold. That is, the first one is the basic threshold, and that is £1 till £37,500 per annum income. If an individual's taxable income is up to 37,500 in the particular tax year, that person is called a basic rate taxpayer. So for a basic rate taxpayer, if the income falls in normal category, then the rate is 20%. But if income falls in dividend, then category, then it's 7.5%. But what if an individual's income, taxable income, increases from 37,500? So now the individual would be classified as a higher rate taxpayer if the income is up to £150,000. So the rate of normal tax rate would be double, that is 40%. And if it is a case of dividend, then the rate would be 32.5. Now, as this is a progressive types of system, so up to 37,500, the rate is 20%, and then on additional income from 37,501 till 1,50,000, the rate would be double, that is 40%. And if an individual earn more income, it exceeds from 1,50,000, then there will be 45% rate, and the person is called additional rate taxpayer. So we have to apply these rates as per the income of the individual, that is taxable income. So in order to apply these rates, first of all, we need to know how to calculate taxable income. The first calculation, that is the uh, taxable income. So this is a pro forma of taxable income. So in this pro forma, you can see that I have made one column of total income, then the first column of non-saving income, then a saving income column, and then a dividend income column. We have to follow this particular format strictly because this is the rule. First, we have to consider non-saving income, then saving income, and then dividend income. So if an individual has three sources of income, then firstly, we have to apply tax on non-saving income, then on saving income, and then on dividend income in the last. So what you have to do is to identify all source of income and then classify it into the relevant column. So I will assume that my client is having an employment income of 28,000. So I have written 28,000 total income and 28,000 non-saving income because it falls in non-saving income. Then my client has interest income. So interest income is fall in saving income category. Then my client earned dividend in this tax year. So dividend income is fall in dividend category. So after identifying all sources of income and then accumulating all sources of income, now find out the total of all source of income. So you can see that as far as total is concerned, now total is 44,000, 28,000, 10,000, and 6,000. So total income and then total of each individual income. So now one important thing is that after identifying total income, an individual gets some sort of relief, which we are not discussing right now. But if there is any relief, then we will deduct that relief and then we will reach towards net income. So first of all, identify total income and then identify net income. In this case, the net income is equal to total income. So after identifying net non-saving income, net saving income, and net dividend income, we have to deduct one more thing, which is very important, and that is the personal allowances. In UK, an individual get personal allowances, and after personal allowances, his income becomes taxable. So you can understand that this personal allowance is a tax-free type of income that on which there is no tax. So if income is greater than personal allowance, then the remaining income is taxable income. So in this case, I have deducted the net income is 44,000. So personal allowance of 12,500 is fixed for this tax year. Previously, it was a bit lower than that in the last tax year. So personal allowance, and then we'll deduct, first of all, personal allowance is to be deducted from the non-saving income. If there is no non-saving income, or personal allowances is more than non-saving income, then we will deduct from saving income, and then we will deduct personal allowance from dividend income. So it's sequential. First you have to deduct personal allowance from non-saving income, then from saving income, and then from dividend income. So after deducting personal allowances, we have now taxable total income, taxable non-saving income, taxable saving income, and taxable dividend income, on which we have to apply the rates that we have discussed previously in this table. Now, if we talk about personal allowances, so personal allowances is available for each individual resident in UK, and that is 12,500 for the tax year 18 and 19. And this is subject to income level of 100,000 pounds. It means what? It means if an individual has income up to 100,000, taxable income up to 100,000, then individual will get 12,500 of personal allowances. But what if an individual's income increases from 100,000 threshold, then what will happen? So if individual's income level is greater than 100,000, then its personal allowance will be reduced. So what is that income level? Is it total income or net income or taxable income? What is that? This income level is called the adjusted net income. So we have to identify adjusted net income in order to check that whether we are eligible for personal allowances or not. So if our adjusted net income is up to 100,000, then we are eligible for full 12,500 personal allowance. Otherwise, we have to compute that how much personal allowance is available for that. Now, in order to find out the adjusted net income, we'll use the same pro forma, that is from total income, then identify net income, and then from net income, we have to deduct two different items. That is, one is called the gross personal pension contribution, another is called the gross gift aid donations, if it is given in the question. So from net income, deduct gross personal pension contribution and gross gift aid donation, and then you will get a figure of ANI. For example, let's assume that we have 1,40,000 of net income, and there is 20,000 of gross PPC, and there is 5,000 of gross gift aid donations. So in this way, you can see that we have 1,15,000 of ANI. So because ANI is greater than 100,000, that means 100% personal allowances is now not available. You have to compute that how much personal allowances is available now. That means if income is below 100,000, then you can deduct the 12,500 figure. Now, this is the rule. If ANI that I have just calculated, if ANI exceed 100,000 pound, then personal allowance will be reduced. So how much it is to be reduced? For every 2 pound excess, that we will get 1 pound reduction. So if the excess is 10,000, then the reduction is half. If the excess is 12,000, then the reduction is half, that is 6,000. And similarly, if ANI is more than 12,500, then the excess is 25,000, and the reduction would be make it personal allowance will be 0. For example, you can see that. Let me just work it out an example. For example, my ANI is 1,10,000. So how much personal allowance now a person can get? So for that, we'll work out in this way. The usual personal allowance is 12,500, and then how much reduction is possible? Let me find out the reduction. So my total ANI is 1,10,000, and the profit threshold is 100,000. So the excess value is 10,000. Now multiply that excess value is by 50%. That means the half of the value, that is 5,000. So in this way, from 12,500, 5,000. So it means we will get 7,500. This is eligible personal allowance to be deducted from the net income. You can also do this calculation in this way, that is 110,000 minus 100,000, and instead of multiplying by 50%, you can divide this by 2, will get the same answer. So both answers are acceptable. Now, as I said, if ANI is, say, suppose 1,26,000, so how much personal allowance is now we can get personal allowance? So in this way, the personal allowance is 12,500 for this year. Now, reduction in personal allowance. So our ANI is 1,26,000. Threshold is 100,000, and into reduction 50%. So this will give me an answer of 13,000. So if I'll deduct 13,000 from personal allowance of 12,500, then my personal allowance becomes 0. You cannot write a negative figure. So it means that whenever the ANI is exceeding 1,25,000, do not calculate, just write it down that personal allowance would be 0. and it would be acceptable in the exam. So let's discuss the rates again. So these are the rates that will be given you in the question. And first of all, you have to identify the total taxable income from this pro forma, and then move back to the rates and apply the rates on saving income, non-saving income, and dividend income. So in the next video, I'll show you that how we can apply these rates on a different taxable income of which is non-saving, saving, dividend, and more working of personal allowances and more variation in the basic concept.